I'm Matt Bishar with REIT.com here in La Quinta, California for REITWise 2013, NAREIT's Law, Accounting, and Finance Conference. Joining me today is Mike McTiernan, Assistant Director of the REIT Group with the Securities and Exchange Commission. Mike, thanks so much for joining us.
Great, thanks for having me.
So how do you think SEC-registered REITs compare with other SEC-registered companies in terms of their disclosures in SEC filings, as well as their disclosures in supplemental filings?
Yeah, sure, and I guess I'll preface it by saying the views I expressed today are my own and not those of the SEC. So as you know, there are two disclosure systems. There is the mandatory system, which is in the Exchange Act filings that public companies are required to file. So those are your 10Ks and 10Qs and 8Ks. But then there is this voluntary system that companies that are interested can provide extra information in their earnings releases, supplemental packages, things like that. I think in terms of the mandatory system, I think REITs provide the information similar to what other companies provide, and that's not surprising. There is required information that has to be in those filings. I think where we see differences is in the voluntary filings, and REITs historically have provided a lot more information than is typically provided by other companies that at least I look at in things like the supplemental packages, which commonly have 30 to 50 pages of additional operating information. So we know that investors and analysts love that. As someone who's focused on investor protection, if they love it, I love it. But we do make sure that REITs understand that those voluntary disclosures are in addition and not in lieu of the mandatory filing. So from time to time we will comment to make sure that some critical things that are in the supplementals to make sure that those are also in the mandatory filings. And I think we also make sure that the story that's being told in the voluntary filing should be consistent with the story that's being told in the 34 Act filing. So from time to time we issue comments on that also.
And what trends are you seeing in terms of registered public offerings by REITs?
It's actually a really interesting time. There's lots of, really on all fronts of the real estate capital markets, we're seeing activities in our traditional traded firm commitment underwritten IPOs by large portfolio property companies. We're seeing activity there. Still seeing a lot of activity in the non-traded space. Some of it, interestingly, moving to a different model of having NAV-based offerings. Still seeing activity in the mortgage REIT space also, seeing mostly filings by people who are going to be playing in the agency MBS space or hybrid agency, non-agency MBS space. And now starting to see a fair amount of M&A activity, most of it originating with non-traded REITs that are either being bought by public companies or that are merging and then listing. We saw a registered roll-up, which I never thought I would ever see, but even that we've seen activity there. One of the more interesting trends I think there's been a fair amount of press on have been the single-family home REITs. So that's been something that's been very interesting, looking at those filings. And I think the novelty of that business model actually raises some really interesting disclosure issues, which we've been working through with registrants. So that's been interesting.
And what are some of the areas that the REIT Group will focus on this year as far as comment letters on REIT registrant filings?
Probably not many surprises in this area, very similar to what we did last year. I think that the basic story that we expect that investors should get from these filings is understanding some color on the operating results, changes in revenues and expenses. Is that being driven by the same store portfolio? How is it being driven by new acquisitions? And then within the same store portfolio, is it driven by increases in average rents, or is it being driven by occupancy? Obviously, both are going to be at play, but getting more color on that. Leasing activity, issuing a lot of comments in that area. This is an example where I think we see a much clearer story being told in the supplemental packages that we're kind of asking to be told in the mandatory filing. So to get a sense of beginning period vacancy to end of period vacancy and what happened in the middle there, both in terms of new space that's come online, new space that's being leased. What's the difference between rental rates on space that is expiring versus new leases, and then leasing costs also. So focused on that, and then continuing to focus on CapEx disclosures. I think in the MD&A section, getting color on the kind of different buckets of CapEx costs. So new developments being broken out, CapEx on your existing portfolio, leasing commissions, and then a kind of other bucket. So I think those are the three areas that we focused on last year. I think I expect if you were to look at the comment letters for this year, they'll be still focused on those areas.
Mike, thank you so much for joining.
Thank you.
For more on this and other REIT news and analysis, be sure to visit REIT.com.